QuickBooks. Let's first enter the invoice. So we're going to say invoice, and let's do this. This is going to be customer one again. Customer one. We'll say tab, tab, tab. And all right, date's fine. And let's say it's going to be an inventory item. So I'm just going to make up an item, inventory item 1, adding that. And I'm going to make it an inventory type item. And we're going to say that let's put 5 on hand so that I can then sell them. Let's put 10 on hand. And so I'll put these on the books. This is going to record a transaction for the purchase, in essence, of the inventory, because we're going to sell the inventory. So we're going to put them on hand automatically like that. Reorder point, let's put 0. Inventory is the asset account that's going to decrease. I'm going to call this inventory item, say item 1. I can't spell item. Inventory, let's just call it inventory 1 then. I want an item there. Item. That's right. Okay. And then we're going to say that we sell them, we're going to say for $155, let's say. Let's try to keep to that example, at least to some degree. Income, and then sales tax is going to be applicable, so we'll keep the sales tax. When we purchase it, we purchase them for, we said 100, so they cost $100, and that'll go to cost of goods sold. Let's save it. All right, so inventory item, we sell them for $155 subject to sales tax, which is at 8% or 167. I think that matches our problem. 167.40. Okay, so what's this going to do? It's going to increase the accounts receivable by the amount plus the sales tax, 167.40. The other side's going to go to revenue only for the 155. The difference of sales tax, 12.40, is going to go to a liability account, sales tax payable to the Board of Equalization or whatever. And then we also going to have inventory is going to go down by the amount of the cost of inventory, which we said was $100, which isn't on the invoice, but we know by the item because it's a perpetual inventory system. And the other side is going to go to cost of goods sold, the expense for us selling the inventory, net impact on net income, $155 minus the $100 cost of goods sold. And that'll be that. So let's go ahead and save it and close it and check it out. Save and close. And go back to the balance sheet, run it to refresh it, going into the AR. There's the 167. That's for the full amount, including the sales tax back. Let's go to the profit and loss, run it. And we should hear, there's the 155, not including the sales tax. Let's go to the balance sheet. The sales tax going to be in the liability section under Board of Equalization, because that's who we pay in California for the sales tax, which is a type of consumption tax. There's the 1240 back. And then we know that the inventory is going to be impacted. So here's the inventory account as an asset. And we made it go up with the purchase of the 10 units at $100. And then we made it go down by the 1 unit that we sold, which is what we're focused on here for the $100. And then we go back. And then we also know that on the income statement, we've got cost of goods sold of $100. And if I go back to the first tab, we've got the subledger for accounts receivable, which I'll track internally by going to the left over here into the sales tab. And then we can go into the, let's say, invoices. And we see then that we want the not due yet invoices, let's say. And so there we have customer 1. There's the 167.40 here. If I go into the customer and I look for the customers that have open invoices, there's customer 1 and there's the 167.40. And if I go into the subledger for inventory, I can go into the reports and I can go into the, let's actually open, I'm going to right click and duplicate this tab, pull it to the right so that I can have this other report, which I'm going to call inventory valuation summary for the date. Let's just bring this up a bit so it encompasses our time frame. So there's the 9 units of inventory. We put 10 on the books. We sold 1. We're down to 9. That is a total inventory of 1,496.25 in units, which should tie out to the balance sheet in inventory 1,496.25. Okay. So now we're going to imagine that this person came in and said, I want to return the inventory, and we're going to go, okay, we'll return it. We have to reverse the transaction then. So I can go into the sales tab and I can see this particular customer who came in or contacted us in some way, shape, or form, customer number 1, and they have this particular invoice which they want to return. Now, if they haven't yet paid us, you might say, well, why don't I just delete it? Or I can void it, right? But that's not typically what we want to do, because we want to have the audit trail. We want to say, okay, they bought it and then they returned it. So one way we could do this is hit the plus button up top, and we want to go into a credit memo. Credit memo, and then I'm going to say this is going to be for customer 1, and then tab, and let's say it happened on the next day up. And then I'm going to mirror exactly what was on the invoice. So it was inventory item 1. So I might look at the invoice to mirror what was on the invoice. And so there it is. So now I've got, this looks like the invoice, but it is a credit memo. So it looks basically the same because it's in essence reversing exactly what we did before. Now, sometimes in the sample file, this tax is being a little bit glitchy, so you might have to record it and then go back into it, and then this basically should calculate. Again, I think the sample company file is a little bit more glitchy than what I've seen in the actual company file, possibly because multiple people are logged into it or something like that. I don't know. But in any case, what's this going to do? Well, it's going to do the opposite of what we did before. It's going to decrease the accounts receivable by 167.40. It's going to record the other side to revenue, but only for the 155. It's going to reduce the revenue. It's going to reduce the sales tax by the difference of the 1240. It's going to put the inventory back on the books of the 100, and then it's going to basically reduce the cost of goods sold by the 100. Net impact on net income is the 155 minus the 100, which would be a decrease, right, of the 55. So let's go ahead and save and close this. Now, before I go and double check that on the financial statements, also note that we would like the credit memo to tie out to the invoice. You'll notice that I entered them separately, right? I'm going to close the hamburger. I had to I put the invoice in, and then I made a credit memo that looked the same, but I didn't really create the credit memo from the invoice, right? But notice these two have been tied out now. The invoice is now being marked off as paid, and the credit memo is being marked off as applied, because by default, it created the payment form, which is basically linking these two together. Now, if you have the settings that are, I believe this happens in the default settings, where QuickBooks is trying to say, hey, I'm going to try to tie, I can see that these two need to be tied together with a payment form. If it's not, then what's going to happen is you're going to have these two amounts on there, but they won't be linked together. So they'll both look like it'll be open. So the net balance would be 0, but these two would not have been tied together. So how did they tie it together? Well, let's look at the payment form, which was basically generated automatically. We'll edit that form. Now, this is the form that normally would be the second step when we enter an invoice. We enter an invoice, increase in accounts receivable, and then we get paid, normally with a check or cash or electronic transfer. In this case, we're getting paid. We're imagining we're kind of getting paid, but we're not actually getting paid. We're going to record the other side to the credit memo, the credit balance that hit the account, and those two things net out. So we check both those off, and that's what the receive payment form is doing here. So now everything is tied out and matched up. So that looks good. Also, just want to point out the terminology of credit. Remember that when we say credit to like a customer, like if we were talking to the customer, we might say, okay, what does it mean? We're going to credit your account. which kind of means similar to the credit memo. You can say, well, that means we're issuing a credit memo to the account. Why do we say we're crediting their account? Because accounts receivable is a debit balance asset account. It goes up with a debit, and then when we get paid, we decrease it with a credit. So that's where you get to this terminology where people just think of crediting. From a customer perspective, they think of someone crediting their account as reducing the amount that they owe, right? If you call the credit card company and you ask them to credit the account, or you ask them to get rid of a penalty or something, and they do it, they're going to say, well, we're going to credit your account. That it came from the term debits and credits. So it's all related, but people lose the idea of debits and credits, and then we use these term credit memos, which again came from the idea of debits and credits because we issued a credit to the receivable account without getting paid, but we still credited their account, right? When we get paid, we credit their account. I just want to point that out just so you can kind of see where these different words, they seem different, but they're all kind of tied together. So in any case, let's go to the balance sheet and see what happened. So now we have the accounts receivable should have gone back down. So there it is. There's the invoice and then the payment form, which is netting the two out. There's nothing being recorded by the payment form. The credit memo is tying it out. The payment form is basically just linking the two together. So then I'm going to go back up. The other side went to the income statement. So if I refresh the income statement, we're going to say that then there's nothing in the revenue account. So if I go into the revenue account, we're going to say what happened. It was invoice and then credit memo reversed it. And then the other side's in the balance sheet under the sales tax. So if I go into the sales tax payable, Board of Equalization, we're going to say, okay, what happened here? Que paso? 1240 went up and then it went back down. Notice that this could have happened in a different year. Maybe we issue the credit memo in another year. Well, we still would have to reduce the sales tax at the point in time we issue the credit memo because we would have paid sales tax before without having received it, right? So we'd have to reverse it in the future. All right, let's go back. Then inventory, if I go up to inventory, we can see inventory, we had a decrease of inventory with the invoice, and then we reversed it, increasing the invoice back up with the credit memo, assuming that they returned the inventory, which maybe they did, or maybe it was damaged, in which case you might not want to do this, which we'll talk about in a second. And then the other side went to cost of goods sold, where we had the cost of goods sold here recording the increase in inventory for us consuming, an increase in cost of goods sold for us consuming the inventory, and then we took it back out, reversing the cost of goods sold. Okay.